Welcome to a new episode of Crypto Gem Finder. 2022 Stock Market Crash, and 2023's Greatest Depression. Recent commentary on the down economy. JP Morgan CEO Jamie Dimon now says that we'll have something worse than a recession. Meta CEO Mark Zuckerberg says, "If I had to bet, I'd say that this might be one of the worst downturns that we've seen in recent history." Galaxy Investment CEO Mike Novogratz says, "The economy is going to collapse. We are going to go into a really fast recession." Tesla and SpaceX CEO Elon Musk, even though he said he has no further TSLA sales planned, he just dumped $7 billion worth more of Tesla stock. Berkshire Hathaway CEO Warren Buffett just saw Berkshire Hathaway lose $44 billion in Q2 2022 alone. He is throwing in the towel on many stocks. Goldman Sachs economists now see a feasible but difficult path for the Fed to defeat inflation without a recession. The technicals. 2022's first half was the worst half to a stock market year in the last 52 years. This saw the S&P 500 move down from 4,818.62 to 3,636.87. This is a range of 1,181.75. Of this range, an ideal Fibonacci retracement, bear market short-term rally, would be 61.8% back up in this range. That takes us 730.32 up from 3,636.87, which gives 4,367.19. Thus, the 50-week simple moving average of the S&P 500, as a further catalyst for resistance, will reject the S&P 500 down, thereby allowing for the horrible stock market downturn to continue. That said, the first half of 2022 was the worst in 52 years, the third quarter was one of the best, and the fourth quarter may end up being the worst stock market quarter on record. Here is a visual. Weekly chart, both the 50-week simple moving average and the completed 61.8% Fibonacci retracement are now serving as the catalyst to resist/reject the S&P 500, thereby allowing for the continuation of 2022's worst market downturn of all time. The daily chart is just as bad. In this case, the price is rejected by the 200-day SMA. 1,929 crash-like margin deleveraging. FINRA margin statistics has been updated to include July. As expected, we got a slight reprieve in debit balances and customers' margin accounts. Nevertheless, graphing the data and adjusting for the near-record inflation for each data point, we can see that we are still in the worst bubble by value in the history of the stock market. Fibonacci of this graph shows that margin has to collapse up to $370 billion more from August's expected margin value, depending on the strength and speed of the deleveraging. FINRA margin totals, adjusted for month-by-month inflation. .com crash, left bubble, 2008 to 2009 crash and Great Recession, middle bubble, and the current bubble, right. Fibonacci retracement values are listed for 61.8% and 78.6% of each deleveraging period. One can observe that the bottom of margin deleveraging bottoms within that range, depending on the strength and speed of the unwinding. 61.8% seems to correspond to slow and weak, and 78.6% seems to correspond to fast and strong. The data shows that the market will continue to deleverage and crash. Thank you for watching. Please do not forget to subscribe, share, like and add your comments.